This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. The Wealth Roundup for the week of November 5th, 2025. Again, Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Lots to discuss since our last podcast, Patrick. We've had a change in the interest rates. We've had a change in the markets. There's been earnings. We've got a budget coming up. So I guess we should start with the markets. Over the last 5 business days, it's been kind of meh, hasn't it?
Yeah, there's been, we're going to get into on the earnings side. I think if what we could see, like today happens to be a risk off day in the market, which is probably emphasizing the fact that over the last 5 days since our last podcast, there hasn't been any additional maybe catalyst to drive the market. Obviously we got all this, energy coming in from the bank rate cuts, which is good. That's a good tailwind for the markets, but S&P 500, TSX both down about 2% over the last week. Gold has kind of dropped below that key support level of 4,000, much like Bitcoin, which is kind of hovering around that 100,000 USD mark. So kind of all of these things that we kind of talked about regularly on our podcast, they're basically flat to slightly negative, even over the last month.
Yet in the last 3 months, we're still seeing a steady sort of rise. So I guess there is some talk about people peeling off earnings on key Canadian and U.S. businesses. What kind of impact does that have on stocks?
Yeah. Certainly for our listeners, I want our listeners to always kind of think about earnings and forward-looking earnings and connect those to the trajectory of stocks. Because I'm a believer that stocks and earnings are tied together. Now, we're just coming through, we're probably to the latter half now of earnings season. So we've had some key US and Canadian businesses report. If we look on the Canadian side, maybe start with the rails. I think the rails are a good barometer with regards to the Canadian economy, especially when we look at the rails and other cargo businesses that are out there. There's no surprise that they are being impacted by tariffs. So, in one of our previous podcasts, we talked about purchasing managers. So this idea that, if businesses were more optimistic right now, they would want to have a lot of inventory. If they are being cautious, they're being very careful with their inventories. And so that, transfers into what we see with cargo being kind of shipped, either coming in from the ports or going across the provinces. So I guess what we can say is that they largely met their expectations, but we had cut our guidance in the previous quarter. So we had kind of anticipated this. And now what we're seeing is that anticipation come out exactly how we thought. At least things didn't get any worse, which I think is maybe the positive to kind of take away from it. Now, in another business, Shopify, this great success story, Canadian digital retailer, earnings were really good. Now, the stock is off today, but I think it's getting kind of caught up in a risk-off trade today. But good to see on that side that, a business that we expected to come through with us with positive earnings gave us good guidance for the future. So probably very much kind of falling into all of this IT and artificial intelligence is that, these names continue to lead the way. Before we get into the U.S. side, just kind of talking about oil and gas, we kind of got to look under the covers a little bit as the oil and gas companies have come out, reported their earnings. We're starting to get a better feel for what the true cost of producing, a barrel of oil globally is or natural gas. And so right now, when we look at, the total market, is we think a cost for a barrel of oil right now is around $70 to $75 a barrel. With West Texas Intermediate oil right now trading at around $61 a barrel, that's below cost. On the natural gas side, same thing is that we're seeing right now the price for natural gas versus the cost is that right now the the price is about 40 cents less than it is to produce that natural gas. So what does that mean? It means that probably right now margins are compressed at the big oil and gas companies, but that probably the global prices need to come up. They need to reflect the fact that we're below cost. And so some equilibrium in the market has to come. So something to look forward to, probably more likely a 2026 story as compared to kind of 2025. On the US side, for the most part, the Mag 7 came out with very good earnings. In fact, we saw some record earnings from Amazon, primarily driven by its AWS. So it's service business. Same thing with Apple, really accelerated into the last quarter on sales. But we had two what I would call quasi misses. So Microsoft, which came out with an earnings per share beat, did provide information on their costs, and because of all the money they're going to spend building out their AI business, we've seen their margins compress. So they're not going to be making as much profits per dollar of earnings as they have in the past. And same thing with Meta, is that Meta came out with really good revenues on their ad revenue, but they also let us know how much money they would be spending in the future. And so the stocks sold off about 16% on that miss. So the market is not looking at these earnings with rose-tinted glasses here, is that they're very happy to see earnings up, but they're also looking at expenses going up and focusing on those margins. Outside of tech, that we'd also see that in some of consumer discretionary like Starbucks and Chipotle. So two big US fast food companies that are, again, trying to grow their earnings, recover. Both have new management in place. We have concerns about where the consumer is at these days. How much does the consumer have to go and spend on $8, frappuccinos, right? And salads with guacamole, avocado. The price of avocado is going up, right? So both those companies have kind of struggled. And I think that they are reflecting that the consumer is having to make some choices in terms of where their spending is at.
You talked about Amazon, and previously, like earlier in the conversation, you brought up AI. I read that Amazon was dropping a bunch of jobs, and I know the jobless rate, unemployment rate has a big impact on the economy and everything that we talk about every week. So with Amazon dropping thousands of jobs, talking about AI taking over those jobs, how, if at all, did that impact what Amazon came out with their earnings?
This seems to be a common theme when publicly traded businesses come out and they're talking about their earnings, and if they're, either going into earnings or shortly after earnings, if they've highlighted the fact that their costs have risen. For most businesses, one of the biggest inputs is the cost of labor. Often there's pressure from shareholders to help the stock price. And so one of the kind of the quickest fixes is going and cutting back on labor. But there's this trade-off. If you want to make this massive investment in AI, and it kind of, to be honest, Terry, it feels like a race. It really feels like a race to AI dominance when you see the kind of money that's being spent and the partnerships that you're seeing between entities. So companies that maybe, they're dominant in the streaming space, or they're dominant in the hardware space. They're doing deals with a chip maker, or they're doing deals with somebody who's going to be building out new AI data centers for AI and cloud computing. Is that you're still going to need the people. I think back to a couple of years ago when Meta laid off a lot of people. They were spending tons and tons of money building out their metaverse. And then quietly they hired a lot of those people back because, again, they set goals, they set targets, they realize, what it's going to take to get to where they want to go. And so they get back out there hiring programmers again. And so I would expect to continue to see this rotation in hiring. But you're right. The longer, Walmart about a month ago indicated that they weren't going to increase their workforce. I want to say it's for the next 5 years. So they wanted to put a hiring freeze basically in place to allow AI, their AI investments that they've made in their business, to see that kind of percolate through their business, kind of force people to, use those applications to save time and money, and making it tough on those managers to say, we're not going to let you increase revenues through headcount. You need to use AI to go and improve those earnings.
November 4th, the federal budget comes down, the first for the Carney Liberal government. They need some opposition help. I think they need 3 MPs to help out with that. There's a lot of billions of additional spending, and the deficit is going to be probably worse than anticipated. So, what should we expect with the budget being announced this week?
We've been trying to read the tea leaves here to get an indication of which way this budget was going to go. Certainly pressure from the U.S. is going to be all over this budget. We've heard from our NATO partners this idea that they want us to spend more money on defense. So we expect some big dollars there, and then a plan to get to target spending. So that's going to have a big cost. There is going to be a big cost to protect certain industries that have been negatively impacted by tariffs. So look for support to the lumber industry, the steel and aluminum industry. Look for support on the auto sector, or a plan in around the auto sector. So internally here at BMO, I think the number that we're throwing around is about $70 billion in new spending, so about 2% of GDP, so lots of spending. But we're also anticipating some cutting. And that cutting tends to come on the social service side. So, look for some cutting, and then also probably some changes to taxes and some various tax brackets. And I'm going to assume here that this is going to be, maybe some incentives. So maybe some tax cuts for incentives for business spending, some things that can help out the economy. And as you pointed out earlier, address jobs. We see high unemployment with young people. We see high unemployment with new Canadians. This budget needs to be targeted on fending off tariffs, diversifying our economy, and getting people working.
Good stuff. The Wealth Roundup for the week of November 5th. Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Thanks, Patrick. Have a terrific vacation.
Hey, thanks, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.